Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take us off course. Now to make it actionable, understandable, and clear. What a week. What a show. Buckle up. The news was coming at us fast and furious this week. We're going to look at a Wall Street Journal article by Mr. Jason Zweig, one of our favorites. What to buy if the election has you worrying about inflation. I find a moment where I have a slight disagreement with Mr. Zweig, but for behavioral reasons only. We then look at one of my favorite people. This is a CNBC article featuring Wharton's Jeremy Siegel. Headline, Trump is the most pro-stock market president in history, Wharton's Jeremy Siegel said. This is published by Yoon Lee. And then we get to take some time in the corner. Our producers have heard your emails and voicemails and letters, and we're going to make the corner bigger. We're going to make the corner great again. It's going to be huge. It's going to be a huge corner. So in the corner, we're looking at some great exercises to do for those you care about should you pass away. We're going to look at dividend growth rates and index funds to help us get out of the crazy euphoria that I feel today. And then we're going to look at a little inverse Kramer. I'm going to teach you what that is. But at the top, Mr. Jason Zweig, what to buy if the election has you worrying about inflation. Subheadline, tax cuts, tariffs, and the deportation of immigrants could crank inflation up again. Inflation-protected securities can protect against your portfolio. Oh, inflation-protected securities. What are these? Well, the acronym TIPS, Treasury Inflation Protected Securities, is what Mr. Zweig is referencing. And he is saying, as the article connotes, hey, inflation could be bad here for a while. We know it may have cooled off, but what are you to do as the investor? And I think he's talking more to the retiree. He may disagree, but I think he's talking more to the retiree. But what are you to do? Well, let's give a little background on these tips and how they work. So if you were an investor and you wanted to buy a bond, let's say U.S. Treasury bond or a note, that would come with interest payments or a fixed percentage that you would be paid upon the maturity of that bond, whether 4 or 5% or 3% upon maturity. You would get that total value of the bond plus that 3%, or you'd be getting the interest payments along the way. Well, if you're worried about inflation, what Mr. Zweig is saying is, hey, there are these Treasury inflation protected securities that will guarantee their payouts after inflation are above a certain amount. So you're insulated from runaway inflation. Why does that matter? Why did that matter? Well, we had some inflation. So in 2021, the article explains, TIPS, these Treasury Inflation Protection Securities funds returned an average of 5.5%, while a U.S. bond index fund fell 1.7%. That'll get people's attention, won't it? So what happened? Investors and financial advisors bought TIPS in titanic quantities, Mr. Zweig said, that year, pouring $42.4 billion into mutual funds and exchange-traded funds that specialize them, according to Morningstar. And right on cue, in 2022, the Fed jacked up interest rates, and guess what? TIPS lost about 12%. What happened next? People bailed. All right, this is what we always try to talk about at the RHF Market Update. Permanence. Find something you can stick with. They yanked $37 billion out of it. Zweig agrees. He says dumping all this money into and out of TIPS makes no sense. Makes no sense at all. He goes through the difference between, well, you could buy these Treasury inflation protected securities individually instead of a fund. Because in individual purchases, you as an investor psychologically know you're going to hold them to maturity, whereas when you buy a fund, it's an amalgamation of various Treasury inflation protected securities and different maturities, and therefore that value is going to go up and down. It is simpler, I'll say. Robert Hunt will say that I'll editorialize and say it's much simpler and therefore easier to simply buy a fund. But Zweig is right. If you ladder, they call it laddering. People do it with certificates of deposits and bonds. But if you ladder your Treasury inflation protected securities, sometimes that can be good for folks. You may know where I'm headed with this. I don't know that I've ever recommended TIPS. Mr. Zwig does. He said at the end of his article, he says, "I'm buying tips. You should too." Another Jeff Johnson, head of fixed income product at Vanguard, he said the best time to be thinking about allocating some money to tips is all the time. So I think it's perfectly fine to buy these tips. Perfectly fine. Does it have permanence? I'm worried about the psychology. If someone said, "Hey, I want by bond allocation, I want these tips," it's a great way to ensure that inflation doesn't ravage my fixed income portfolio. Fine. But what happens? What happens when inflation drops? What is going to happen if we get a little bit of deflation? It's no fun. It's no fun at all. So here at the corner, I see the very best hedge against inflation: common stocks. Now, in the short run, in the 1970s, you might raise your hand and say, wait, the 70s? You bet there can be decades that are very rough. And it's hard if you take a time frame about a decade or less. But on longer time frames, common stocks do an excellent job. An excellent job against inflation. That's where I think you should focus your energies and your efforts with inflation hedging. If you want to do tips, that's fine, but be prepared to stick with it. Because if you don't stick with it, you'll do what this article lamented, which is a whole host of investors rushed in, tips lost 12% in a year, and then they rushed out, and it was almost the same amount. It was that kind of, frenetic investing activity that lacks permanence, because we keep our time horizon long here, and that didn't happen with tips. So I say keep it simple. You don't have to do it. If you want to, you can. Come talk to me. And then our next article in CNBC by Yoon Lee, headline: Trump is the most pro-stock market president in history. Wharton's Jeremy Siegel says the stock market could enjoy a bigger boost from President-elect Donald Trump than any previous administration thanks to his pro-business policies, according to Jeremy Siegel, finance professor at the Wharton School, the University of Pennsylvania. Touch of background on Professor Siegel. He's probably the most bullish person I've ever, well, maybe not ever, but one of the most I've ever heard. So perhaps we can filter him appropriately. He did write one of my favorite books, Stocks for the Long Run. It's excellent. It'll make you want to drop the book and go buy stocks immediately. That's the kind of bull he is. Why am I bringing this article up? Well, the Robert Hunt Financial Index, which is a proprietary index I have related to anecdotal conversations I have with clients and folks throughout the week, is at a fever pitch. I have never experienced the enthusiasm I've experienced from clients and acquaintances alike for common stocks than I have this week. Yep. Now, I recognize 1999. I was a young lad, so I'm a bit hazy. I'm a bit hazy on the euphoria. I remember it. I participated in it. Lost money in it, unfortunately. But I'm noticing more people tell me, I want to get as much as I can in the stock market. I want to get as much as I can in the stock market. I want to get as much as I can in the stock market. Random lunch, random conversation, client meeting. I'm kind of going, oh, dear. Dear. This article explains what's happening. The S&P 500 soared 4.66% last week for its best week since November 2023. Trading above 6,000 for the first time. Tesla, whose CEO Elon Musk is a prominent backer of Trump, saw shares skyrocket 29% to return to a $1 trillion market cap. Banks had big rallies. JP Morgan, Chase, Wells Fargo. So here's what I worry about when my RHF indicator goes this high. It's not that I have any clue whether the stock market will go up or down in the next year or the year after or over Trump's term. I worry that we're losing permanence. Can we stick with whatever plans we're implementing? That is what concerns me. The euphoria for stocks is causing, here's what it's causing. Hey, do I need to really be in cash here for something I'm going to spend money on in a year? Boom, I'm going to go to the stock market. Do I really need to be this conservative? Should I have borrowed more money and bet on stocks? Maybe. Probably not. It lacks permanence. We want to seek to solve for 50 years. When you look at the data, it's not obvious that a pro-stock market president will result in a stock market that increases a lot, which is usually what people would think. That's just not how life works. The stock market is a voting machine in the short run, a weighing machine in the long run, but a voting machine in the short run. So a whole host of things could happen that could cause the stock market to go down. You want to prepare yourself to have a 50-year vision for your investments. Don't get caught up in this Trump bump, they call it, where, oh, great, risk on, here we go. I don't think that's wise. I'm perfectly fine with someone having a financial plan that can stand the test of time. And therefore, if you're invested appropriately, great, Trump bump or not. But let us be suspicious of euphoria causing us to alter allocations. But I would recommend the book. Siegel, I find wonderful, and he's always an optimist, so kind of nice to have folks like that on TV every now and again, because it's a bunch of pessimists on TV, typically. And now you're entering the corner. It's a large Robert Hunt Financial Market Update corner. Won't you be mine? Could you be mine? Won't you be my neighbor? Welcome to the corner. I wanted to start off because I find it instructive. I want to start off with a couple stories. One, I was speaking with a wonderful man whom I serve, who reminded me, and I had just a big smile, that they advocated going long Bitcoin at about 19,000 a coin. You wake up and it's close to 90,000 today. And it doesn't shock me, said no. And we had a great discussion. I think what's hard is when do you sell? When do you sell? Price discovery on any of these cryptocurrencies is, to me, I recognize others have different ways of discerning value. To me, I don't know how to do it. If I doubled my money, I'd sell right away. How could I stick with it? How could I have ever started from $1 to 90,000? I don't know. But the cryptocurrency market has been hot, as President Trump forebodes a more friendly regulatory environment for cryptocurrencies. But at the update, we have still not purchased a cryptocurrency because I don't know how to assign value to it. It lacks permanence for me. But I want to tell you what does give me permanence. So I was going back when the stock market's hot, and the RHF market indicator is solid green, and everyone wants to buy stocks. I go back and say, hold on just a second here. Why do we buy stocks? Well, ultimately for the cash flows they provide. Now, you may receive that in the form of a dividend or a share buyback. But if you take the index fund, I'll take the American Index Fund, VTI, Victor Tango Indigo, Vanguard's total market index, and say, okay, what was the dividend that was being paid out about a decade ago? Okay, so a decade ago, 2014, VTI, what was it paying out? Versus what is it paying out today? What will it pay out in December? So if you go back a decade, you look in December 22nd, 2014, VTI paid out 56 cents a share. It does quarterly distributions. If you go back, let's say 11 years, December 20th of 2013, 49 cents a share. So we'll call it 50 cents a share. In 2013, December, the quarterly distribution was 50 cents a share. And you can see all down the road, December is usually the biggest distribution, so we'll keep it simple to say December 20th, 2013, 50 cents a share. You go up to present day, and December 2023, it distributed about $1 a share for that December quarterly distribution. Okay, so you went from 11 years ago, 50-cent distribution in December, and a 10-year gap to 2023 would be $1. So it doubled. So in a decade, simple stuff here, in a decade, the dividend from VTI, this American index, doubled. Now that's exciting investing. The rule of 72, if you want to Google the rule of 72, it's quick math. At what rate does something have to increase to double over 10 years? 7.2. You just divide 72 divided by 7.2, 10 years. It's kind of cool. If you return 10% a year, what's 72 divided by 10? It would take 7.2 years to double. Check it out. Do a Google. The rule of 72 is a very neat mathematical heuristic to speed up our thinking on doublings, how long it takes something to double. But you see what I'm doing? I'm avoiding this price action. The price action is very dangerous. It's seductive. It's tricky. It can go white hot and totally cold. It's the steady compounding of cash flow generation that I think we should focus on in moments especially like this. Because goodness, It's white hot out there, people. Crypto, stocks, whatever. It's hot out there. And I will say, as rosy a report I just gave you on dividends in America, it's not rosy in international dividends. It's a horror show. It's a house of horrors. It is no bueno. You've got currency headwinds, all the rest. So I like people being globally diversified because we just don't know what part of the world will do well. The U.S. certainly has done well the last decade, last really 17 years. And then in the corner, I thought this was funny. There's something called the inverse Kramer, which is when Jim Cramer, the famous CNBC figurehead, buys. You sell the security. When he sells the security, you buy it. In researching it, I found it was a strategy that actually did poorly last year. So poorly that a group created an ETF ticker to be the inverse Kramer ticker, and it failed because it was down so much because Kramer was doing okay. Wouldn't you know it? The inverse Kramer this year, it's up 56% in a year. It leads the Pelosi tracker, which is another famous kind of funny index where you follow Nancy and Paul Pelosi's stock trades, and they've done very well, which of course the implication is there's inside info, which of course there is. I still don't think it's enough for you or I to follow it, but there you go, the inverse Kramer. I got a chuckle, but it just shows you it is so hard to pick stocks. So hard. And it's so hard to find out who's going to be good at picking stocks. Because we could do inverse a lot of people. It's easy to pick on Jim Cramer because he's a public figurehead and he actually comes out with his stock picks on TV. It's a hard business saying which stock will go up, which stock will go down. Very tough. I encourage you, because I think the moment crosses my mind, it probably crosses yours, I think I could do this. This doesn't seem that hard. I've had all these ideas in the past about this company and that. I would have picked NVIDIA. Sure. I would have picked them. Well, to be completely transparent, honest with ourselves and candid, I encourage you to have a little journal, a log, phantom trades. All right, I'll buy NVIDIA here, sell NVIDIA here. I think you'll find out very quickly stock picking is a very tough game. And that's with fake money. Imagine the real money. It gets harder. And then in closing in the corner, I found this helpful. There's something called the green box exercise. It explains the days after you die will be awful for your loved ones. Here's one way to make it easier for them. And it gives all these things. It says, collect all the infos your loved ones will need, put it in a box, and store it somewhere secure. So this is it says it'll save family, lawyers, and so many others from so many loose ends. They say letters to your spouse, children, parents, mementos, copy of your will, copy of your power of attorney, computer passwords. This is the one I have not done. I probably need to do. Copy of credit cards, copy of passport and birth certificate, details of all insurance, medical, dental, for your business, an org chart, recommendations on who to trust, list of trusted advisors, lawyers, accountants, CPAs, hourly financial advisors, I allowed there. Assets, they want you to put personal financial statements, details of trust, copies of physical property, titles, cars, houses, all that stuff. Oh, and I love this funeral burial instructions. Got to do that too. So any instructions not addressed in your will. This is all the stuff we never want to do. I do not have all this done, and I'm telling you, hey, it's a pretty decent idea. However, I've seen what happens. I've helped folks who sadly have lost a spouse suddenly, and without this, it is so hard. And the tough thing is we don't know when it's our time to go. Only the Lord knows that. And so if we don't have something like this, we can get taken by surprise, sadly, and the surviving spouse is really in a tough spot, just searching through the house, going through files, hoping they can find something. Let's not make it too tough on them. This green box exercise, I think, has some merit. Get started, do the best you can. Because when we're thinking about our own death, that's the ultimate time horizon long. Because we are focused on keeping costs low, keeping investing simple, and as the green box exercise recommends, keeping that time horizon real long. I'm talking eternal long, because that's what's going to give you the best shot on your investing journey. Until next time.